Hey everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a specific stock that's caught our attention on the hard-to-borrow screener, the Growhub Limited, trading under the ticker TGHL. We're going to break down what makes this stock hard to borrow, what that could mean, and what you need to understand about the potential mechanics of a short squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on the Growhub Limited, or TGHL. This company operates in the technology and software infrastructure sector, specifically focusing on product traceability, data analytics, and product trading facilitation solutions both in Singapore and internationally. With a current market cap of just $19.07 million, it's a microcap player in the tech space. Show TGHL logo/company info on screen. Looking at its recent price action, TGHL has seen some interesting movements. Today, the stock is down 9.19%. Over the last 5 days, it's also down 9.19%. However, if we stretch that out to the last 30 days, TGHL is actually up 18.15%. This kind of volatility is common in smaller cap stocks, and is something to keep in mind as we discuss its hard-to-borrow status. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and what is this thing called cost to borrow, or CTB? When investors want to short a stock, they first have to borrow shares from a broker. They then sell those borrowed shares, hoping to buy them back later at a low price and return them, profiting from the difference. Brokers charge a fee for lending out these shares, much like an interest rate on a loan. This is the cost to borrow. When a stock is hard to borrow, it means there are very few shares available for short sellers to get their hands on, either because existing short positions have already tied up most of the float, or because owners aren't lending their shares. When demand for borrowed shares is high and supply is low, the CTB fee can skyrocket. And yes, it can, and often does, exceed 100% on an annualized basis. This high fee acts as a significant deterrent and cost for short sellers. Why this stock is hard to borrow right now. Now, let's talk about why the Growhub Limited TGHL popped up on our hard to borrow screener. The annualized cost to borrow fee for TGHL is a staggering 773.1%. Highlights 773.1% on screen. That's one of the highest numbers we see, indicating immense demand to short the stock against a very limited supply of shares. While the exact number of shares currently available to borrow is unknown, the 773.1% fee tells us the supply is incredibly tight. TGHL has an estimated float of 12.7 million shares. A high CTB on a relatively small float can be a powerful combination. It's important to look at volume too. Today's volume for TGHL was only 49,300 shares. Contrast that with its 30-day average volume of 10,276,586 shares. The relative volume today is effectively Xerox average. This means current trading interest is exceptionally low, which can impact how squeeze might unfold if it were to materialize. Our internal composite squeeze score for TGHL, which factors in CTB level, borrow supply, float size, volume, and technical setup, stands at 46.5 out of 100. This score indicates some potential, but it's far from a guaranteed squeeze signal. Squeeze mechanics explained. So, how does a short squeeze actually work? Imagine short sellers have borrowed and sold a massive number of TGHL shares, pushing the stock price down. Now, if positive news comes out, or simply if the stock starts to move upwards for any reason, those short sellers begin to feel the pressure. Every dollar the stock rises, they lose money. Compounding this, they're paying that exorbitant 773.1% cost to borrow fee daily. As the stock rises, some short sellers will decide to cut their losses. To do this, they have to buy back the shares they borrowed and sold. This buying pressure drives the price even higher. This forces more short sellers to cover, creating a cascade effect, a short squeeze where the buying to cover short positions fuels a rapid and dramatic increase in the stock price. Dilution risk check. A critical factor to consider when evaluating any potential short squeeze candidate is dilution. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can effectively lower the value of existing shares and, critically for a squeeze, provide more shares for short sellers to borrow, thus easing the pressure and potentially negating a squeeze entirely, even with a high cost to borrow. For the Grow Hub Limited TGHL, we've checked for recent dilutive SEC filings, things like -1s, -3s, or 424 BS in the last 90 days, and found none. So, currently, there are no immediate red flags for dilution from new share offerings that could hinder a squeeze thesis. This is a positive sign for the squeeze potential, but it doesn't eliminate all risks. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, even at 773.1% cost to borrow, here is what we'd be watching. First, keep an eye on the borrow desk for any updates on shares available to short. If that number starts to shrink even further, or if the CTB fee continues to climb, that's a signal of increasing pressure. Second, monitor the price action and volume. While today's volume was incredibly low at 49,300 shares, a sudden surge in buying volume, especially on green days, could indicate short covering or new buying interest challenging the short thesis. Remember, a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction in the bearish thesis for TGHL and are willing to pay a premium to maintain their positions, perhaps believing the stock is fundamentally overvalued. So, the Grow Hub Limited TGHL, a $19.07 million market cap tech company, is clearly exhibiting characteristics of a hard-to-borrow stock with that eye-popping 773.1% annualized cost to borrow fee. With an estimated float of 12.7 million shares and no recent dilution, the fundamental mechanics for a short squeeze could be present if buying pressure were to emerge. But remember, the current extremely low volume relative to its average suggests little current interest. Always do your own thorough research. Understand the risks involved, especially with microcap stocks like TGHL. If you found this breakdown helpful, please hit that like button, subscribe to the channel for more deep dives, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you.